Welcome to another market update.
Woo!
Relatively slow week on the back of Thanksgiving and the holiday weekend. We also have some important economic data that'll be coming out later this week that I'm sure the market is waiting on to move in, either direction. But we still have some good stories to get into, so let's just jump into it with a quick summary. So the recent Fed minutes came out and suggested the slowing of the pace of rate hikes. U.S. job openings came out today, Wednesday, and declined 353,000 to 10.3 million. In line with expectations, but it declined nonetheless. And then we have, I'm sure everybody is aware of this to some extent, the China protests going on that are rocking tech manufacturing. And then there is a potential for an OPEC oil production cut December 4th at their next meeting.
Not crazy.
Qatar struck a 15-year LNG or liquid natural gas deal with Germany.
Nice.
And then Bitcoin miners are being forced to capitulate as the hash price remains near all-time highs and the price continues to decline.
And we say bye-bye.
But before we get into all that, let's just go over a quick recap of last week as usual. So we had the Fed strongly considering a move down to a 50 basis point hike, and that's kind of been reaffirmed with the Fed minutes. We had new home sales in the U.S. surprise to the upside.
Whoa.
Japan inflation hit 3.7% for headline and 3.6% for core.
Yep.
Nothing compared to Western numbers, but it was still, at least I think for core, a 40-year high. And then Japan officials also indicated that they could be abandoning their loose monetary policy and yield curve control.
Say what?
We'll see. Obviously, nothing's for sure. And then we have the ECB, which is set to raise rates by 50 basis points in December. Anything super significant, everybody's pretty much anticipating it, but still want to watch out for that. Saudi Arabia denied rumors of an OPEC plus production increase, and now they're considering a cut.
Come on, man.
I'm sure Biden's upset about that one. And then obviously the FTX contagion is just continuing to take victim after victim, and Genesis was its most recent, although BlockFi officially filed for bankruptcy. Not going to touch on it too much since I've touched on it before. But yeah, last week Genesis was another victim, and its parent company, DCG, Digital Currency Group, which also owns the Grayscale Trust, is saying it won't affect the Grayscale Trust, but obviously who knows, so definitely stay tuned for that one. All right, but with that out of the way, let's just jump into our first story. So first up, we got the Fed minutes story. So in the Fed minutes, they said that a substantial majority of Fed officials see slowdown in rate hikes soon.
Whoa.
Now, they usually hint at these things ahead of time. They don't like to surprise markets too much. So if you start seeing more and more hints, last week, we talked about them hinting at a 50 basis point hike, and now in the Fed minutes, they're kind of hinting at it. So it definitely is on the table. I haven't checked recently what the market is pricing. I suppose I could just do that real quick. It's fedwatch.com from CME Group. If you guys want to check it out, pretty useful tool. So right now they're actually, so basically 70% chance of a 50 basis point hike and a 30% chance of 75 basis points. So the market is definitely leaning more towards 50. But yeah, let's just get into this story. So a substantial majority of policymakers at the Federal Reserve's meeting earlier this month agreed it would likely soon be appropriate, all these qualifiers, likely soon, to slow the pace of interest rate hikes as debate broadened over the implications of the U.S. Central Bank's rapid tightening of monetary policy, according to the minutes from the session. The readout of the November 1st to 2nd meeting, at which the Fed raised its policy rate by 0.75 of a percentage point for the fourth straight time, showed officials were largely satisfied they could move rates in smaller, more deliberate steps as the economy adjusted to more expensive credit and concerns about overshooting seemed to increase. So in the last meeting, Powell mentioned for the first time the long and variable lags of monetary policy, which everyone viewed as this dovish thing because it's indicating that the effects of their interest rate hikes are going to hit later on, and so that may be reason to pause to see how they affect the economy because maybe they haven't fully hit the economy yet. But yeah, there's a lot of Fed members that are now worried about overshooting things and tightening too much. So, and from their perspective, even though the market is going to probably misinterpret it because they don't, even if they go down to 50 basis points, that's not necessarily super dovish. They can, and they've said this before, they can go down to 50 basis points and then end up having the terminal rate still be higher. They just do it in smaller increments. So they do 50 basis points maybe 3 more times or whatever it is, instead of like a 75 basis point hike and then 25, then a pause or whatever it may be. And so they could still, the terminal rate is the most important thing to focus on, I guess, even though the market's going to climb on to, oh my God, it's a decrease of 25 basis points. That's super bullish, whatever. But I still think you need to focus on the terminal rate, and that's kind of what they're saying. But still, if they do lower the pace, that obviously opens the door for them getting closer to pausing. But let's just continue on. So a slower pace would better allow the Federal Open Market Committee to assess progress toward its goals of maximum employment and price stability, which were released on Wednesday from the Fed minutes. There's a quote. So the uncertain lags and magnitudes associated with the effects of monetary policy actions on economic activity and inflation were among the reasons cited. More important than the size of coming rate increases, the minutes noted, was an emerging focus on just how high rates will need to rise to lower inflation. So the terminal rate, right? So that is the most important thing. People focus too much on the meeting by meeting increases when the terminal rate is really what matters, because that is the sum of all the increases, at the end. That's the interest rate, like the Fed funds rate, that's where it's going to peak. So they need to calibrate that carefully in coming months is what they're focusing on, right? So terminal rate, not individual meetings. Even though the individual meetings do matter, still, we need to, they're saying that they need the market or want the market to kind of focus on the latter. Not the rate increases, but the terminal rate.
Totally.
So with monetary policy approaching a sufficiently restrictive stance, participants emphasize that the level to which the committee ultimately raised the target range and the evolution of the policy stance thereafter had become more important considerations than the pace. The ultimate landing spot for policy will hinge heavily on the path of inflation in coming months, obviously, and whether recent lower than expected readings become an established trend down. So I want to see consistent trends going down for a lot of things. Inflation, last week I pointed out, I think it was Fed Waller, who said obviously they're focusing on inflation. Everybody knows that, but it's also housing, employment, and some of the non-housing indicators. And last week we had, what was it? Pull it up real quick. So yeah, new home sales surprised to the upside. So that's one of those things that was not going the right way. But we've recently had a lot of manufacturing PMIs come down to very recessionary levels. The Chicago PMI, for example, came in at 37.5 or something, which so anything below 50 is considered contractionary or recessionary. And it came in at 37.5, a drop from like 45 to 37. That's about as bleak as it gets. That's pretty bad. And granted, that is only for Chicago, but still, that is potentially indicative of the overall economy, or at least maybe the direction or whatever. But so we're starting to see a lot of signs that the economy is slowing, and accordingly, that Fed monetary policy or tightening should also slow. I think we also had the jobs report today that it was in line with expectations, but it was lower than the previous one, so we have fewer job openings, and I guess I'll wait to talk about that in a sec. But summary of this thing, so substantial majority, it's mostly in the title, substantial majority of Fed officials see a slowdown in rate hikes soon, and they're really acknowledging all these leading indicators that are screaming at them that the economy is coming to a screeching halt, and that monetary policy has already affected the economy in a very material way. But we'll see at the next meeting. Obviously, we have more economic data that I alluded to in the beginning that is going to be coming out, like unemployment numbers, I believe is the most significant. But let's just go ahead and transition to the next story. So the job openings. And this came out today on Wednesday. The number of job openings in the United States dropped by 353,000 to 10.3 million in October, roughly in line with market expectations, and suggesting demand for workers started moderating amid a softer economic outlook and higher interest rates. So the reason this is significant is, so if there are more job openings, that basically means that employers are kind of competing for workers. Because if you have fewer job openings, you have more workers competing for fewer jobs. So if you kind of view this in terms of supply and demand, and there is in relative terms, a larger supply of workers relative to jobs, then there's going to be downward pressure on wages, which is what Powell wants to see. Because if there are more workers competing for fewer jobs, then you're going to, it's kind of like the leverage is in the employer's hands, so they can give out lower wages, and that is helpful for inflation because lower wages means less money going around, and it's just in general, it's just a good sign for inflation. But if you have more job openings, relative to the workers, then that can be lead to upward pressure on wages. So there are a lot of reasons that you want to see, at least from the Fed's perspective, you want to see job openings declining. Overall employment and economic activity declining, but that is one of the main things I would say that they're focused on, is because of the pressure it applies to wages.
Right.
But yeah, that's pretty much it. I guess we can just go over this chart right here. So last month, it was a surprise to the upside. Not anything super crazy, but still not the direction they wanted to see. And this recent one came back down. So it was 10.6 million, the last print, and now it's 10.3. And the month before that, in August, was 10.2. So we haven't fully gotten below that. Still heading in the right direction. I wouldn't be surprised at all if this continues headed lower, especially given, just where the economy seems to be headed based on all the leading indicators, the way inflation's going down, and just there's a lot of deflation, commodity prices declining, and just a lot of stuff pointing to economic activity contracting. So layoffs, there's going to be fewer job openings potentially because people aren't hiring as much, yada, yada, yada. But moral of the story, job openings are looking like they are declining. It's very good very good in the sense that it's what the Fed wants to see. Because right now we're in this weird area where bad news is good news because it means the Fed will pivot. So fewer job openings in, a normal world is not necessarily a good thing, but because the Fed wants to curb inflation, then it kind of is. But, neither here nor there. Let's transition to the next story now. So China protests has been a huge story just because it's been absolute madness over there, them trying to maintain this COVID zero policy. And it's really starting to be like there's this stark comparison now, especially with the World Cup going on, because you can see all these thousands of fans in the in the crowd in the stands who don't have masks. They're just hanging out, living life normally, and China's like, wait, the world is back on track, and we're over here just getting just COVID zero, locked in our houses. And there was like a huge fire in some building or apartment complex or something that was locked down. And in China, when you're locked down, it's not like America when we were locked down in the beginning of COVID, where you are, like you're just in your house, but you're not like boarded in or guarded. But in China, they will literally board up apartment complexes so you can't leave. And that was a problem because when this fire happened, they couldn't escape. And so it led to people dying. And that was, probably one of the main reasons, but one of the catalysts for why, these protests have kind of started. But again, let me just get into the actual story. So huge Foxconn iPhone plant. This is responsible for something like, I can't remember the exact percent. It might be in this article. It's like 60 or 80% of all iPhone production is through this Foxconn plant. So this, dealing with the protests has a very material effect on Apple and their sales, because the iPhone itself is responsible for like 50% of Apple's revenue. So if the majority of the production for their biggest, revenue driver is affected, that's going to affect Apple. And Apple is obviously the biggest company in the world. And if Apple goes down, that's really going to be like leading the market down, tech down. But yeah, so let's jump into this. Hundreds of workers joined protests at Foxconn's flagship iPhone plant in China, with some men smashing surveillance cameras and windows. Footage uploaded on social media showed. The rare scenes of open dissent in China mark an escalation of unrest at the massive factory in Zhengzhou city that has come to symbolize a dangerous buildup and frustration with the country's ultra-severe COVID rules, as well as inept handling of the situation by the world's largest contract manufacturer. Reuters earlier reported that iPhone output at this factory could slump by as much as 30% in November, and that Foxconn aimed to resume full production there by the second half of the month. Apple had warned it expects lower shipments for premium iPhone 14 models than previously anticipated. With the factory down, that makes sense. So this is the important part. So Foxconn accounts for 70% of iPhone shipments globally. It makes most of the phones at the Zhengzhou plant, though it has other smaller production sites in India and southern China. But basically, China is where, it's not just for Apple. I guess this is specifically focused on Apple, but there are so many manufacturing plants, chip manufacturing plants, or whatever it is. All these manufacturing parts of the supply chains for tons and tons of companies are wildly affected by this because they're shut down. Their production is shut down, and you don't have your products to sell. Obviously, how are you going to make money? And this has been an ongoing problem, obviously, because China's been doing this COVID zero thing for a while. Just, kind of like a light switch, just turning the economy on and off whenever COVID spikes. And they're at record cases right now, all-time highs. So that's kind of what's sparking all this, the shutdowns and boarding people up and putting them in these COVID internment camps, which is fucking wild.
Not crazy.
But yeah, so this is, I guess what I'm trying to say, not specific to Apple, even though this actual story is specific to Apple. You got all these big tech names, Microsoft, Texas Instruments. They rely on chip manufacturing or chip plants that are in China, and there's a whole host of companies that rely on Chinese manufacturing. And so if you're constantly affecting that, it's going to hurt their top and bottom lines. They're not going to be able to get their products out. There's going to be shortages in all sorts of ways. But yeah, so this is a story definitely to follow. Not that it's hard to miss, just because China is the second biggest economy in the world, obviously. And this protest thing has become, kind of headline news. But it's anybody's guess as to what Xi Jinping, the president of China, what he's going to end up doing. I feel like he's going to stay pretty hardcore with this COVID zero thing. And maybe their only way of getting out of it is for everyone to just get COVID and get herd immunity, because I don't see the COVID zero policy really working clearly, especially with how contagious these variants are. But yeah, this will be definitely a huge story to follow because, it affects the biggest companies in the world. It affects overall demand for commodities because if China shut down, they're not using commodities like oil, demand goes down, and other inputs, copper, all this stuff. And then obviously the manufacturing for every company that goes through China, which is most companies, because China is the manufacturing base of the world. All these things are going to affect markets. So this is a huge story that you really need to watch. And it's kind of one of those, as time goes on, politics is becoming more and more part of markets, because this is not really a fundamental thing. This is what is Xi Jinping going to do about COVID zero? And that has serious implications for markets, which is kind of an interesting thing in and of itself. That is how markets are, or I guess macroeconomics is transitioning. It's a huge focus on geopolitics. But yeah, either way, let's move on. But crazy story, definitely follow it. All right, next up we got OPEC. So OPEC's been playing this weird cat and mouse game with the U.S. and Western countries, because obviously they want oil production to increase to lower prices, and Saudi Arabia specifically, but I guess OPEC more broadly, are kind of battling that. They are not really on board. They're not only not going to increase, but they're saying they're going to cut production further because they want to bolster prices and keep them, higher than where they are, or at least at a maintain the, a certain price level in the face of demand destruction. They don't want the demand destruction to lower prices too much. So if need be, they will cut production, which is, kind of ironic because everybody's asking them to increase it. So OPEC and its allies are expected to consider deeper supply curbs when they meet this weekend. I think it's December 4th, against the backdrop of a faltering global oil market. Saudi Arabia and its partners surprised traders and drew a fierce rebuke from President Joe Biden.
Come on, man.
When they announced a 2 million barrel a day cut back last month. Even so, prices have since weakened, briefly slipping to almost $80 a barrel in London as the situation in China deteriorates. You know, the demand for China faltering, and I can't remember what the actual amount is, but I think with them locked down, and this could be totally wrong. I want to say Zero Hedge said something about like 5 million barrels a day difference with China in lockdown versus not in lockdown, which is huge in the oil market because any marginal increase or decrease can affect the price pretty substantially. But yeah, so that's what a lot of people have kind of been, I guess what's leading to oil going down is the China thing and I guess overall just demand destruction because of global recession. So delegates from the group, OPEC, who until this week had predicted they would pause to assess the impact of the cuts, now say additional reductions could be an option.
Whoa.
Discussions within the alliance haven't yet formally got underway before the meeting on December 4th, but they are strongly considering reductions. So right now, I believe everybody is kind of, who's closely following the oil market is saying it's either going to be a rollover of current policy, meaning, just status quo as is, what their previous stance was, they're just going to maintain, or there's going to be a production cut, not a production increase. Nobody's really anticipating that at all. So last week, Saudi Energy Minister Prince, this is a name, Abdulaziz bin Salman said OPEC Plus was ready to intervene with further supply reductions if it was required to balance supply and demand. OPEC will probably choose between rollover or further cuts. And that's the chief oil analyst and co-founder of Consultant Energy Aspects who said that. But yeah, so I guess the important point to take away from this is that even though oil is sliding, the OPEC Plus, which is a huge influence on the oil market, they're the cartel of oil, as they're often referred to. They are going to do what they can to prevent it from slipping too much. If that means cutting production, that's at least what they're hinting at. That's what they're going to do. Like right here when they said reductions if required to balance supply and demand. If demand starts slipping because of China or global recession, whatever it is, demand destruction, they will balance that out with less supply. Clearly they don't care if the U.S. wants them to increase oil, because if they weren't going to do it before the midterms when the U.S. really, really wanted them to, why would they do it now when the U.S. is the U.S. still would want them to, but definitely less so because it's not as politically helpful. It's like nobody's up for election right now, so it doesn't matter in that sense. But so if they didn't do it then, they're probably not going to do it now. And it sounds like they are definitely leaning more towards oil production cuts in the future.
Yep.
All right, so let's go to our next story. So Qatar ministers see no upper limit to LNG deliveries to Germany in this 15-year deal. So Qatar's energy minister, these names, man, Saad Al-Kaabi, sees no limit to the amount of liquefied natural gas that the country is willing to ship to Germany. So with Europe and Germany specifically not being able to secure natural gas from Russia, which was a substantial amount of the natural gas that they received to power their whole economy, they are now trying to secure other places or other, inputs of natural gas, and that has mostly been from Qatar and the West, like the United States and Canada. Now, this isn't this is a solution in the sense that they will be securing natural gas, but it is not a cheaper solution. Liquefied natural gas is just inherently more expensive because the process of liquefying it and shipping it is just way more expensive than transitioning it or transporting it through these pipelines in it's like gaseous state. So this is going to help in the sense that they're going to be getting, natural gas, have a, seemingly reliable supply, but it is still going to be more expensive in relative terms. So it's not as if this is a panacea for Germany or some major success. Still good though. So the minister said Qatar was working with companies such as Uniper, which is Germany's biggest gas company, and RWE on more shipments. The interview was published as Qatar Energy on ConocoPhillips signed 2 sales and purchase agreements to export 2 million tons of LNG annually to Germany for at least 15 years from 2026. So I guess it isn't even going to start until 2026. I actually didn't see that part earlier, which, that is several years down the road. So that seems a little bit interesting. So this isn't even a solution in the next few years when arguably they need it the most, because in 2026, who knows, maybe we'll be buying natural gas from Russia again. So that seems weird, but still 15 years from 2026. They're playing the long game, which is important because they got to really figure out how to not be so reliant on someone like Russia, but transitioning your dependence on Russia to Middle Eastern states, it's like, is it really that different? It's like, what happens if, Qatar is maybe not as bad as something like Saudi Arabia, but it's kind of like I guess maybe like lesser of two evils, but it doesn't really seem like it's that smart longer term. But honestly, what are their options? That's kind of the unfortunate reality. But still, making moves to secure liquefied natural gas, very helpful. But given that it is not until 2026 that it's looking like it will be fully going into effect. I guess I'd have to look. I'm sure they're securing some level of natural gas before that, but maybe not, within the parameters of the specific deal. I have to look more into it. But yeah, still, important story. Good for Germany, but we'll see how that plays out in the next few years when they really need it the most.
You're a fucking idiot.
Okay, and let's get to our crypto story. Whoops. So, I guess maybe some context. Actually, I'll probably get it as I go, but just the hash rate for Bitcoin has been going up despite the price going down. So we actually are hitting all-time highs just repeatedly for the hash price, even in the face of the FTX thing. And when the hash price goes up, that basically makes the difficulty adjustment for Bitcoin go up, and that makes it more expensive for people to mine. More competitive, and basically squeezes miners, especially because their income is in Bitcoin, because they're mining blocks to earn Bitcoin rewards. And if the price of Bitcoin goes down while their energy costs go up because the difficulty adjustment is increasing, they basically get squeezed from both sides, and their margins start to collapse, especially if they don't have a very, very cheap energy source secured. Then they can start being basically not profitable, and that leads them to sell some sort of assets they have to raise capital to stay afloat, because they are maybe like not literally losing money. And what they can sell are Bitcoin on their balance sheet, or something like mining rigs. So they sell their ASICs or whatever it is. But whatever they have to sell, they sell to raise capital, because otherwise, they're dead in the water essentially. So that's the the context for this. But let's go ahead and get into the story. So the collapse of the crypto exchange FTX is causing a historic event in the Bitcoin market. Yesterday, I'm not sure when this was published, but it doesn't really matter, on-chain data signaled the second wave of a Bitcoin miner capitulation in one cycle. Historically, miners have had a massive impact on the Bitcoin price. The now heralded miner capitulation will put further selling pressure on the Bitcoin price, which is experiencing a historically bad November, down 21%. Pretty wild.
And we say bye-bye.
On-chain data shows that the second wave of miner capitulation has now begun, suggesting further pain for the Bitcoin price. So this only gets worse unless one of those two things gives out, meaning the hash price or the hash rate goes down, so they're not getting squeezed on the energy front because the difficulty adjustment also lowers, or the Bitcoin price goes up because then they will be making more money, from mining the actual Bitcoin, earning the block rewards. So unless one of those things changes, miners are going to be under a lot of pressure, especially the ones that are kind of on the cusp of profitability. Maybe they don't have the cheapest energy cost, but they're still like a little bit profitable right now. If the hash rate stays level, but the Bitcoin price continues to trickle down, even if it's just slowly, eventually they're going to get squeezed out. And the problem with that is it can force them to sell Bitcoin, which downward pressure on the price, which adds to the problem. It's kind of like this reflexive downward pressure on price. It's similar to the gilt thing in the UK. If anyone was following that story, these pension funds had to sell the gilts to basically raise capital for their margin calls. And when they sold the gilts, that put downward pressure on them, which increased the need for margin calls because it was basically lowering the price of their collateral even more. That was, causing the margin call. And so that's kind of what would happen here. You sell the Bitcoin and you're almost kind of inducing this margin call on all the miners because you're lowering the price of Bitcoin by adding all this selling pressure to raise capital because the Bitcoin price is too low for you to make money. And then that will cause other miners also have to sell because they themselves are now unprofitable or they need to raise capital and sell Bitcoin. So it can lead to this kind of, not necessarily flash crash, but it can put a lot of downward pressure on price because it's just forcing all these miners into capitulation and constantly putting more downward pressure on price that forces more miners to capitulate and so on and so on.
Totally.
So let's just continue on. Nevertheless, miners' margins have been and continue to be massively squeezed since June, the first capitulation event in the cycle. Despite this, the hash rate still rose to an all-time high until recently. So I think it's come off the all-time highs. You can kind of see in this chart. So this is the, if you look here, the blue line, because there's a lot of ribbons here. The blue line right here is the 7-day moving average of the hash rate. Actually, I think you might be able to see I don't think you can really see the black line too well. It's kind of in line with I don't think you can really see it in this picture. But the blue line right here is basically the moving average of the hash rate. And you can see it was basically an all-time high around, it was just making all-time highs, even in the face of the FTX collapse. So this right here was the FTX collapse, and we were still basically at all-time highs for the hash rate. But it has come down a little bit, so alleviating some of the pressure on the miners. But still, with price going down at a faster pace, that may not really help that much, because if the hash rate doesn't go down at the same rate as the actual price, then you're still getting squeezed.
Aww.
I think I got some more in here. So in the Bitcoin miner net position change chart, it can be seen that miners have been selling aggressively over the past month, and that is this chart right here. So you can see the net position is pretty clear, the colors. So it wasn't until about the beginning of September that you started seeing the net position change, meaning miners were net sellers rather than buyers or holders of Bitcoin that they earn through the mining. And then you can see right around the FTX price, so this huge drop might be a little bit hard to see, is kind of the FTX debacle. And you can see right around that time you had a huge jump, or I guess change, in the miner net position to the downside, where they started selling even more, largely because they are getting squeezed. As the price goes down, they have to sell in order to raise capital to stay afloat. So this is basically what they're referring to by the net position change. All right, and last little bit, something to keep in mind is that miner capitulation is usually the last stage of a Bitcoin bear market. In the 2018 cycle, the Bitcoin hash rate continued to rise as the price reached the 6,000 mark until the final miner capitulation came at 3,000. So a lot of people point to this as a potential bottom signal or close to the bottom signal. I'm not necessarily encouraging people to go catch falling knives, but just given everything that's gone on in crypto and Bitcoin, when you have the FTX thing going on, and look, that's still unfolding. There's still a lot more to go on. Who knows how many counterparties are going to prove to be insolvent because of this. It's more and more coming up every day. So there still is a lot of tail risk in there. But with the Bitcoin price holding up as, I guess well as it did in the face of that, and now with the miner capitulation kind of adding more selling pressure to Bitcoin, it is kind of a good sign that Bitcoin is holding up well. And, if it doesn't really, if this doesn't force a bottom, it's like, what will? Obviously, going to regret saying that, because who knows what's going to happen. It seems to be like a black swan event every fucking 2 days in crypto. But it doesn't seem like a terrible time to maybe get like a dollar cost averaging going. Again, not financial advice, but still, historically, it also is a time when the Bitcoin price roughly bottoms, when you have these minor capitulations. So just food for thought, I guess. But yeah, I thought I'd bring that up because it is kind of a big deal. But yeah, that does it for the stories. But before I get out of here, let's go over what we can look forward to the remaining week, or I guess next week too. So tomorrow, I can't really see this in the white, but tomorrow we got US ISM manufacturing PMI and European area unemployment numbers. On Friday, we got the US non-farm payroll, which is huge. and the unemployment numbers. So that is kind of the big one that I believe the market is mostly waiting for, just because that is a significant influence on where the Fed is going to take monetary policy. So non-farm payroll and unemployment numbers on Friday. Definitely watch for that. And then next Monday, we have US ISM non-manufacturing, so like services, PMI, and Australian interest rate decision, if anybody cares about that.
Little bitch.
Sorry, Australia. But yeah, that pretty much does it for today. So on that note, as always, stay happy, humble, and most importantly, solvent. I'll catch you all next week.
And we say bye-bye.